Well, good morning, everybody, and welcome to the Kushner Report for July of 2026. As we complete, hard to believe that July is over and we begin August 1st on Saturday. So today we've got an interesting program. What we're going to do is cover two specific areas. And one we're going to talk about, first of all, we're going to look at the latest in terms of our agenda today. We're going to look at key economic indicators, the global economy, the domestic economy, mergers and acquisitions, other significant economic news, and what's ahead in the remainder of 2026. We'll look at the latest update on the manufacturing outlook and the technology outlook. So I want to take a look at the manufacturing area first. So first of all, U.S. manufacturing is really projected to grow about 2 to 4% this year, reflecting moderate expansion. Growth is uneven across subsectors, but we're seeing advanced industries and high-tech manufacturing are really outperforming all the traditional sectors, such as metals and textiles. When we look at some of the key drivers, we're looking at companies that are continuing to moving production back closer into the United States to the markets to reduce global risks. At the same time, we're looking at updates in automation, such as robotics, AI, and predictive maintenance and improved productivity. Manufacturers also investing heavily in energy efficient processes such as electric vehicle, supply chains, and also carbon reduction. And when we look at infrastructure, the federal government infrastructure programs are driving construction related manufacturing demand. From a risk perspective, it's the same thing we've had for a long time. It's labor shortages in skills in the trade and technical areas, specifically in the area of semiconductors, as we're bringing on new plants across the United States. Something about 15 are being opened over the next couple of years, and we need people to fill those jobs. High paying, good technology jobs, and the companies are willing to train people for those opportunities as well. And if we look at inflation and input costs continue to rise in steel, aluminum, semiconductors, all affecting margins. On a global basis, we're seeing impacting exports and supply chain impact across the board. Now let's take a look at the vertical markets. So first of all, we'll look at the automotive and transportation sector, and growth is expected to be somewhere between 3 and 5%, led by electric vehicle and autonomous vehicle production. The drivers here are really shifts to electronic vehicles, battery innovation, and also advanced driver assistance programs. The risks, however, are semiconductor shortages, regulatory hurdles, and of course, global competition. When we look at the trends, localization of electronic battery manufacturing and partnerships with tech firms for autonomous platforms. Aerospace is solid this year. It's looking at 4 to 6%, with commercial aerospace really recovering from the post-pandemic area, and we're seeing steady defense spending. The growth is projected to be somewhere between 4 to 6%. When you look at commercial airline expansion and defense modernization programs, those are really the key focal points for this year. However, on the risk side, we're looking at geographical tensions affecting defense budgets and the supply chain constraints. The trends really focus on lightweight materials such as 3D printing for components and AI in the manufacturing processes. In the area of chemicals and manufacturing and materials, we're seeing 2 to 4% growth, driven by demand in construction, automotive, and high-tech sectors. The drivers, of course, are specialty chemicals for electronic values and batteries, and advanced polymers and industrial coatings. And commodity prices and volatility are still a very concern, and of course, environmental regulations across the country. In the trends, we're looking at sustainable chemistry and circular economy approaches, and also biomaterials. So those are real areas of the trends as we move forward in the rest of the year. In the area of electronics and semiconductors, as I mentioned earlier, growth is somewhere between 5 and 7%. It's the fastest growing manufacturing vertical. The drivers are really AI, cloud computing, and automotive and high-tech innovation. But the risks are, again, supply chain disruptions and international trade restrictions. And the trends are AI chip manufacturing and chip fabrication, primarily located now in the United States. Machining and equipment areas, we're looking at growth between 3 to 5%, and it's supported by industrial automation and infrastructure projects. Some of the drivers will be to increase factory automation, renewable energy equipment, and then, of course, precision manufacturing and machinery. And the risks, however, are capital spending and sensitivity to interest rates, which remain relatively high. And of course, the trends are smart factories and predictive maintenance and robotic integration across the board. And the old traditional area of beverage and food and beverage manufacturing is roughly 1 to 2% stable but modest for the year. And there's rising demand for packaged goods and specialty foods and automation and processing. And if we look at the risks, again, we have a labor issue, supply and logistics, and also commodity price inflation. The trends are really sustainable packaging, plant-based products, and automation in packaging lines. The pharmaceutical and biotech areas, again, very strong. Growth is between 4 and 6%. This is driven by ongoing drug development, biotech, innovation, and personalized medicine. The drivers are, keep in mind, an aging population, regulatory approvals, and AI-driven drug discovery. The risks, however, are regulatory hurdles, patent cliffs, and also pricing pressures. And the trends are in biomanufacturing is really the key driver in this sector. When we look at consumer products, somewhere around 2 to 3% growth this year, modest but stable. And the demand is really for home goods, so electronics and lifestyle products. The risks here are retail demand and fluctuations, and of course, import competition. And of course, the trends are in automating assembly, sustainable materials, and fulfillment optimization. Now we look at the side of the structural side, and then basically the workforce and skill shortages is still a major problem across the board. The talent gap remains a major constraint with millions of unfilled jobs projected as skills development doesn't accelerate. And even as robotic increases, manufacturer competes for workers who can operate in advanced systems and participate in interpreting data and managing automated systems. So there's a lot of opportunities in those areas. In the area of supply chain uncertainty, again, tariffs and shifting trade agreements and policy unpredictability are really forcing most companies to invest cautiously and really rethink sourcing. Some firms are resourcing parts of their supply chain domestically to reduce risk and capture incentives. So in summary, for this area, the 2026 manufacturing is really a year of transformation rather than broad expansion. And we're looking at cautious growth, potentially tied to digital technologies in critical sectors such as semiconductors. And this will be offset by the persistent workforce constraints. Again, keep that in mind. We'll talk about that later in the presentation. So we look at high growth areas. Well, electronics, aerospace, electronic vehicle supply chains, and farm and biotech are really the key areas of growth. From an investment perspective, we're looking at automation, AI integration, supply chain resilience, and energy efficient processes. The real key here is the risk reduction, and that is diversifying sources, hedging commodity prices, and again, workforce skill upskilling programs to develop the workforce of the future. Now let's take a look at the tech sector. So the U.S. technology sector is expected to see moderate but robust growth this year, and we're projecting revenues to go out somewhere between 5 and 8% across the board. Some of the key drivers, for example, we've got integration of generative AI automation tools across industries is really driving enterprise investments. When we look at cloud and edge computing, we're continuing to see migration to cloud platforms, hybrid cloud models, and edge computing solutions. In the semiconductor area, we're looking at ongoing demand for high performance computing and AI specific chips. In the area of security and compliance, which is a major concern, we're looking at risking regulatory demands and cyber threats are really boosting security and hardware services. So we're seeing more money being invested now for the cybersecurity area. In the M&A area, we're looking at strategic acquisitions, and those are particularly in AI, cybersecurity, and cloud services, which are refocusing really the dynamics of market traditions and so-called ongoing business development. So what are the risks? Well, you have potential interest rate volatility is affecting financing. And of course, we've got global geographical problems across the world, particularly with China, which is impacting supply chains. And of course, there's regulatory pressures around AI, data privacy, and antitrust, which is slowing down some of the segments. Now we'll take a look at the software side of the tech place. Well, first of all, market growth is expected to grow between 7 and 10%, slightly higher than the hardware area due to demand for digital transformation. When we look at enterprise software, we're looking at cloud first adoption remains high, and we're looking at AI-driven analytics and workflow automation are really the major areas and the key drivers. The area of cybersecurity is increasing threats, ransomware, and regulatory compliance requirements. This area is expected to grow between 12 and 15% this year. We look at the platforms, and that is generated AI integration into productivity, customer service, and creative tools is accelerating. And we're seeing strong development and investments from both startups and high-tech companies. In the area of SaaS, which is software as a service, it remains revenue driven. Enterprises are increasingly preferring multi-cloud SaaS solutions for their companies rather than investing in their own internal sources. And we look at some of the trends. Software companies are really emphasizing verticalization solutions, and that is industry-specific AI analytics software. From a subscription standpoint, it's a usage place, and it's gaining a tremendous amount of traction in industries across the country. Now let's take a look at the hardware sector, and that is the market growth here is expected to be somewhere between 4 and 6% because consumer demand is normalizing the post-pandemic, but enterprise adoption remains steady. So in the area of semiconductors, for example, AI and high-performance computing chips are really the main growth drivers. Supply chain diversification, such as the United States, Taiwan, and South Korea, will continue. When we look at consumer electronics, the devices like smartphones, tablets, and wearables may see flat growth this year. In the area of enterprise hardware, growth is really fueled by cloud infrastructure expansion, edge computing, and data centers. And of course, data center hardware remains a strong sensitive to enterprise IT budgets. In the area of devices, we're looking at the adoption and growth in industrial and healthcare sectors. And the trends are that hardware vendors are increasingly bundling with software and AI services for recurring revenue. And the focus here is on energy efficient AI adoption and chips. Let's take a look at the vertical markets. So in the healthcare area, the real focus is on generative AI for clinical documentation and decision support. The risks, however, are data privacy, bias models, and regulatory scrutiny around AI-assisted diagnostics. In the area of finance services, and that's banking, insurance, and capital markets, there's a focus on AI for risk, fraud, and credit, automation in the back office, and real-time payments. The real issue here is the fact that risks are focused really around compliance and legacy core system slowing transformation. And for those of you on the call, in the technology space, you know that legacy means it's the old stuff moving over to the new transformation, which always takes a lot of time, and there's a lot of issues that you have to deal with before everything works 100%. In the manufacturing area, we're looking at key bets are really around robotics and cobots. That's automation around mobile robots, digital twins, and predictive maintenance. The risks here are integration complexity, and that is IT security and constraints for smaller manufacturers. In the area of retail, consumer, and hospitality, dynamic pricing. AI is driving merchandising and computer vision checkouts. And you're looking at the risks here. Again, we look at thin margins. Data ethics could be around personalization. And we look at the public sector, and that is cloud migration, digital citizen services, cybersecurity modernization, and data platforms for the public health, transportation, and area of safety. The risks is complex, very complex procurement complexity, skills gaps, and also heightened sensitivity around transparency and fairness. And they're sort of behind the mainstream of American business. When we look at the area of media, telecom and entertainment, 5G and edge computing, the network automation with AI, and again, immersive content for gaming, sports, and collaboration. The risks here are really around uncertain monetization of 5G and regulatory pressure on data content. And it's somewhat unclear of monetization of 5G as we move forward. In the area of the energy sector, which is energy, utilities, and resources, you've got grid digitization, and that is smart meters, sensors, AI for demand forecasting and asset management, and analytics for renewable integration. The risk again goes back to legacy infrastructure, and that is cyber threats to critical systems and also regulatory complexity. In the automotive and transportation and logistics side, we're looking at automated driving features such as electronic vehicle platforms and AI optimized logistics networks. The real risks here are dealing with safety and liability for automated features, supply chain volatility, and of course, charging infrastructure gaps across the country. In the area of education, we're looking at AI tutoring and learning assistance and analytics for student success. The real risk here is not only funding constraints and digital divide, but it's also the policy and debate on how should AI be used in the classrooms. When we turn to the investment aspect of things, we're looking at software companies are generally more resilient to macroeconomic shocks due to subscription models and AI-driven growth. In the hardware space, we're seeing that face supply chain and price pressures, but benefit from AI and cloud infrastructure demand. In the M&A opportunities, we're looking at AI startups, cybersecurity, edge computing, and cloud-focused firms as attractive targets. In the area of regulatory considerations, we're looking at AI governance, data privacy, antitrust rules may also influence strategic choices for both software and hardware. So in summary, the 2026 technology sector is really set to be robust, and that's anchored by the sharp emphasis on artificial intelligence and cybersecurity. Keep in mind that AI-driven information transform is really taking a major impact in the area of manufacturing, automotive, and energy, and they're all catching up as fast as they can in the area of data transformation to remain competitive in the world markets. Now let's take a look at the key economic indicators. We're going to take a look now at GDP, inflation, unemployment at both the federal and California level, and then the price per barrel of oil. So our most current information tells us that the global GDP is projected to go at around 2.7% this year, and then rising to 3% next year. When you look at our GDP, it's somewhere around 2.2%, and then probably remaining around that area as well. So that's the latest for the United States, 2.2 across the board. Inflation, as you know, just went out. I'll talk about that later. It's still projected somewhere around 3.5%. And that's much higher than the target level of 2% that's been the goal for decades. Inflation in 2027 is expected to decline by 2.4%. A lot of this is projected around the cost of oil and other types of chemicals and foils around the world. The unemployment rate is running really somewhere around 4.2% on a national basis and then dropping down to 4.1%. And as you know, California usually trails the rest of the country. So right now we're projecting going out somewhere around 4.8% and then dropping down to 4.6%. When we look at the price of oil, the West Texas Intermediary, we're really looking at a range of between $90 and $110. So less than a week ago, oil was at $93 a barrel, and it closed recently somewhere around 84, just under $84 a barrel. And I've got some other data I'll cover as we go through the presentation. So let's look at the global economy, just some key points here. So first of all, Japan announced that they're raising their interest rate by 25 basis points, and this is because they're acting to curb the yen slide against the US dollar. And the European economy is optimistic for the year. Growth is expected to continue, though at a modest pace, while inflation and geopolitical risks remain their biggest concerns. So economic growth is running somewhere between 1.5% and 2% for the year. The real concern here is, of course, higher energy costs have really become a big headwind, and inflation remains above target. However, the labor markets remain relatively resilient in Europe's common market. In Germany, the recovery remains fragile after several years of weak profit and growth. The economy is beginning to stabilize, though it faces still significant structural and geopolitical challenges going forward. Canada remains vulnerable to global trade tensions, energy prices, and of course, geopolitical developments. Their economy is beginning to recover and expected to see growth this year somewhere between 1.2 and 1.5%, and then moving up almost 2% in 2007. So let's look at the domestic economy. So first of all, U.S. credit debt remains significantly high. However, we're beginning to see a slight decline in that. When we closed the first quarter of 2026, it went out at $1.25 trillion in credit. It's unbelievable how we've gotten there. But again, people are still living on credit cards. And U.S. foreclosures are active, remain below the recession that we had back in the 2008 to 2012 timeframe. And again, we're seeing a gradual increasing over the past couple of years, primarily attributed to mortgage rates and the affordability pressure it's placing on many homeowners across the country. The U.S. economy is resilient, but it's not accelerating in the second half of the year. We're looking at the economy remaining relatively flat, and we'll see where this goes going forward. The labor market is stable, but it's not expected to heat up, and I'll talk more about that as we move forward. There's a lot of opportunities out there, but a lot of companies have got jobs on hold. So now let's take a look at some other economic indicators. When we look at the June inflation package, I mentioned earlier, it closed out at 3.5%, which is better than expected. And that's due primarily, we saw a 4%, 4/10 of a point decline, and this is adjusted for the 3.5%. And again, this is primarily attributed, we saw oil prices falling, which has affected all factors of the economy. When we look at the retail sales, before I forget, wholesale prices declined by 3/10 of a point, and again, that's tied to the drop in gasoline prices. The retail sales area was another strong month at 2/10 of a point in June, and this is up 6.7% over a year ago. And again, U.S. retail and food service sales rose again across the board. Now let's take a look at the employment picture for the U.S. So we had a very modest gain of jobs across the country in June at 57,000. The employment rate dropped from 4.3 to 4.2%. Now, when you look at these sectors, business and professional services, health and education had a strong month. What was surprising is leisure and hospitality really took a hit this month. Good news is manufacturing gained, and we saw some other areas of the economy where there were negative growth. Something to think about, there were 7.6 million job openings in May of this year. And many of those jobs are still on hold. Companies are still collecting resumes, interviewing people, etc. But we're not seeing a lot of movement going forward with adding personnel. This is a thing that came out of the government. There are approximately 12.15 million employees in the United States are being underutilized. They're either part-time or they're working two jobs. And then we have what they call the underemployment rate, which I'm not sure how they calculate it, but it's estimated to be somewhere between 7 and 8%. Now, California employment jobs, this is very meager 2,900 jobs during the month. And unemployment, you see where it is? It declined to 5.2%. So it's going to take a lot of activity to get down to 4.8 by the end of the year. One of the things that was surprising is that there were only 100 white-collar jobs created in the month of June. If you look at just the different vertical markets, you can see what's happened. The only area of significance was in the area of healthcare and education. Every other group had lost jobs, lost positions. And again, that was in the month of June. Now we take a look at the interest rates. In June, the market held, they decided by a vote of 12 to nothing. They voted to hold rates current and not move anything at all. So the rates are still between 3.5% and 3.25%. Now, the Federal Reserve had a meeting yesterday, and they decided to hold on, not raise rates and not lower rates, but to reevaluate the situation as we go forward into October of this year. And the vote on this was 9-3. When we look at mortgage rates, the mortgage rates inched up slightly to 6.58%. We're still in the 6 range. As I told you in the forecast earlier in the year, back in January, we're still looking at mortgage rates still hovering around 6%, maybe a little higher, a little bit lower, but right now the indication are it's still going to be above 6% going forward. Good news in the manufacturing index. We still have a very strong market here. The index dropped to 53.3 from 54 last month in May. However, as I told you before, if we remain above 50 basis points, it's in a growth mode as far as being in contraction. So manufacturing is moving in the right direction. When we look at small business confidence level, the PMI went up 2.1% to 97.4. We're moving in the right direction. Again, the target here is to be at 100. And when we take a look at consumer confidence, it inched up slightly to 91.2. We're still below that 100, but it's still moving in the direction. So even though it's slow, this is good news in terms of both of those sectors. I mentioned crude oil prices. So yesterday, before we finished the report, it dropped down to 84.64. About a week ago, it was almost $93 a barrel. So it's going to vacillate every day until this issues in the Middle East get resolved. Now, looking at housing starts, they fell by 9% compared to previous month, and this is really reflecting the challenges that are being faced by rising mortgage rates across the country. In terms of new home sales, good news here, they rose by 1.6%. In the May, we saw an annual rate of about 628,000 new homes went on the market, which is good news. In terms of home sales, let's take a look at Southern California. I mean, it was for the realtors that are on the market or on the program today, good news across the board. So first of all, LA County, the home price is over $910,000 per unit, and the growth there and the price went up by 8.6% in June. Sales rose by 2.6% from May, and sales increased by 6.8% over June of 2025. In Orange County, the median price of $1,490,000 decreased by 0.2 of a point, but sales were up by 8% in May over May, and the sales increased by 12.2% over June of 2025. And in San Diego, the median price of $1,085,000 increased by 2.5% in June. Sales were up 11.6% in June, and they increased by 16.1% over June of 25. So in the real estate market locally here, both in LA, Orange County, and San Diego, we had lots of good results. Now, the productivity information for the second quarter has not been released. Hopefully, we'll have that by the time we talk in October. Now, if we take a look at the company displacements, the good news is there are fewer that had major layoffs during the month. However, as you may recall, after the last program, Spirit Airlines closed after 34 years, and there were 17,000 jobs were eliminated. However, 2,000 were picked up by other airlines. So right now they have a negative 15,000. Walmart laid off 1,000 corporate people. Intuit, 3,000. Heineken Beer, 6,000. Cisco again up north, 4,500. Microsoft, 4,800. And then KPMG last week, 1,000. And then Verizon has announced they're closing a lot of offices across the country. And basically, they're eliminating 2,500 jobs in stores and 500 at the corporate level. Now let's take a look at the M&A area. I mean, again, we've seen robust growth and opportunities across the board over the last 90 days. You know, keep in mind, there's a couple of things to keep in mind. And one of them is that when you have slow to flat organic growth, the only way you're going to grow is to go find other companies to acquire that fit with you strategically or vertically into your business. And at the same time is diversifying parts of your portfolio that don't work. As you know, that of the mergers and acquisitions I'm going to talk about today, there's a tremendous amount of activity taking place in the biotech space. A lot of this has to do with a lot of the patents are coming due, which means you need to have new drugs and new development money. So the way to grow is by acquiring other companies. So let's get started. So we're going to look at Berkshire Hathaway, which you're familiar with, has bought Taylor Morrison Home Corporation for $8.5 billion. The company is a developer and home builder with over 350 communities across 21 countries and 12 states. Real, as I mentioned earlier, it's a couple of folks on the call today that are in real estate. They bought Remax for $800 million, $880 million, basically, a little over that. And essentially, Remax basically has 8,500 offices across the country and 145,000 agents. Bayer, again, is active. They're buying Profuse for $2.45 billion, and they're bolstering their eye drug pipeline. Shell Oil Company is active. They've acquired Canadian producer ARC Resources for $16.4 billion. The deal is expected to help Shell increase oil output for them on a daily basis of 370,000 barrels of equivalent per day, which is good news in that industry. Eli Lilly has been very active over the last 6 months. They're buying a therapeutics company for $2.3 billion. This is a privately held blood cancer drug developer. Then we're looking at Sun Pharma, who's buying drug maker Organon for $11.75 billion. This is India's largest deal. And the issue here is they're focusing now on dermatology, oncology, and obesity to offset declining U.S. sales. So that was a major investment by this Indian firm. And Roche is acquiring digital pathology firm Path AI for a little over $1 billion. This is helping analysis of patent tissue samples and diagnostic tools. We look at MasterCard made a splash. They just bought a company called BVNK for $1.8 billion, and they're betting on the future of blockchain. Here they're talking about there's clear signals yet that stable coins are moving from the edge of finance toward the core of global payment infrastructure, and we'll see how that develops in the future. Now, Apollo is acquiring Auto Interiors, and that deal is worth approximately $2.1 billion. This is a company leading supplier of automotive interior systems. AMX is acquiring Indicor Instrumentation for $5 billion. This is a situation where it's providing mission critical solutions used in demanding industrial and laboratory environments. And then Long Lake Management is acquiring AMX. So American Express Global Business is being sold to them, to this company, moving out of that particular area. So that's another niche that American Express is getting out of. And then Bullish is acquiring Equinity for $4.2 billion. Basically, Bullish is a New York-based company, and they're going to scale tokenization across public markets and financial infrastructure. And then those of you familiar with Comcast, they're spinning off NBC, Universal, and Sky into separate companies. And for example, NBC Universal will include like Universal Pictures, Film Studios, NBC, Telemundo Broadcasting Networks, NBC News, and streaming Peacock, and also the cable channel Bravo. And then Wellington Management is buying mutual fund division of Hartford Insurance as the company wants to move into the wealth management area. And Novanta is acquiring Riverpoint Medical to expand surgical consumable portfolio products by $1.2 billion. And Insight is acquiring Vega Therapeutics, another biotech. This is expanding its hematology portfolio into the bleeding disorders area of medicine. And then Dana, which is an Ohio-based company, is buying Eaton's mobility unit for $5.1 billion. And then we have a company called On Semiconductor. They're buying Synoptics for $7 billion. So On Semiconductor is a semiconductor company really that develops power management, analog, and sensing solutions for automotive, industrial, and data center and energy applications. And Synaptics is a semiconductor company that develops connectivity, sensing and edge, and AI applications for the consumers, such as PCs and automotive applications. So that's going to be a real good, solid merger. When we look at CR is acquiring, CR is an Irish-based company. They're a building company that is involved in manufacturing of supplies and aggregates, cement, concrete, and asphalt, and engineered construction products. And Acrosa is a Dallas-based manufacturer. So Ireland is moving into the United States in this particular area. So they're expanding their portfolio. Jiffy Lube has been around for many years, 25 years, and you may recall that it's been owned by Shell Oil for many years, and it's being sold. Jiffy Lube encompasses about 2,000 service centers across North America. And this is a $1.3 billion deal and being sold to private equity. Kroger, which is the giant in the food industry, as you may recall, the deal with attempting to buy Vons and Albertsons failed miserably. They've made another acquisition. They're moving into the expanding with Giant Eagle, family-owned chain, which for $1.65 billion. This allowed another 179 stores, supermarket standalones, and pharmacies to the portfolio. And this is across like Ohio, Virginia, Maryland, and Indiana. So again, they're continuing to grow by acquisition. And then we look at Lockheed Martin. And this is interesting. They're acquiring Ultra Maritime Solutions. Now, Ultra Maritime is a global defense company. It specializes in advanced undersea warfare and anti-submarine warfare. And all these capabilities are tied to naval forces. And this is a deal for what, just under $4 billion. And then we have Novartis is acquiring, makes its bio-antibiotic drug company for $1.5 billion. This is a company that's involved in transforming cancer treatments and really focusing on specifically around killing cancer cells in different environments. Then Martin Marietta is buying La Hoist of North America, and that with this is basically it would merge with their limestone supplier company to grow and expand their business and demands for lime products. And then finally, we have Eli Lilly again. They've made several acquisitions this year. They're buying this company called Atai Beckley for $2.8 billion. And what this is a clinical stage biotechnology company that develops psychedelic based mental health treatments. So that kind of takes you through the M&A area. Again, keep in mind, you've seen a lot of things taking place in the biotech space primarily, and that's going to continue. Now let's take a look at some other economic news. As I mentioned earlier in the presentation, Spirit Airlines, after 34 years, is gone. They eliminated 17,000 positions. About 2,000 were picked up by other airlines just after the company closed. And then Subway has been struggling for quite a while. They're closing another 700 stores, dealing with the constraints they have around the franchise model. So a few years ago, they had 22,000 locations, and they're down to below 19,000 now. And this is all about cash flow. And the historic Coca-Cola plant in California is closing after 114 years. This is a soda bottling plant in Ventura, and it's shutting its doors. And they're moving about 85 to 100 people to other locations in Southern California. I mean, it's been an epic place in Ventura for years. Then we have Microsoft's AI chief made an announcement last week at the technology session saying that in 18 months, for all white collar work to be done will be automated by AI. And this is interesting. And it talked about the human performances in most professional tasks are going to focus on accounting, legal, marketing, and project management will all be fully automated. So I think that's quite interesting. That's within the next 2 years. And then one of America's oldest brands is being discontinued for us. They used to drink beer when we were all kids. After 177 years, Schlitz Premium Beer is going out of business, and it's based upon increased costs to ship and store the products. So there's a 177-year-old company brand is gone. Then Red Robin is selling 30 locations across the country for $23.5 million in a refranchising push. This is all for them to try to raise cash flow. And then Toyota North America is planning operations expansion in San Antonio. This is good news. They're they're investing in a new plant for $3.6 billion, and that will create 2,000 new jobs in the south side near the Toyota plant. And then U.S. Postal Service announced on July the 14th, they raised postage stamps again to 4 cents, and it's now 82 cents to send a first-class letter. And then the Men's Warehouse, which is one of the only ones left that sells men's clothes specifically. As you know, they struggled over the last few years, and they closed 400 stores back in 2020. Well, they're starting to grow again, and they're going to file an IPO to go public, and they want to run and expand, have 1,000 locations across the country. So it's quite interesting what you see taking place. So that kind of takes you through other economic news. So what I want to do now is I want to open up for Q&A. But what I'd like to do before I have Ed get on, I'd like to see if what other questions you all may have, and we're going to unmute everybody. And then Ed's going to get into the technology.